Coming up on the Music and Money Show, I have Martin North from Digital Finance Analytics, and we're going to talk about mortgage stress. Welcome to the Music and Money Show. Just to fill in my listeners, how is mortgage stress currently defined?
Yeah, good question, and thanks for the opportunity of speaking with you. So, mortgage stress, when I look at it, I don't take a set percentage of income going to service the mortgage. So some people will say if you're spending more than 30% of income, then you're in stress.
Mm-hmm.
I'm looking at it in a cash flow basis. So I look at money coming in, money going out on an ongoing basis, and that includes all the other costs of living and also the mortgage repayments. And the reason I do it like that is because if you think about it, you can't look at the mortgage in isolation from the rest of a household finances, right?
Oh, absolutely.
Because it all comes in from several sources and all goes out through lots of other sources. And if you haven't got enough left at the end of the month, then either you're going to dip into your savings or you're going to put something on credit cards.
Mm-hmm.
And whilst you can do that for a little while, eventually things get quite serious. So mortgage stress I define as not having sufficient money coming in each month from various sources, salary and other sources, to be able to cover the costs of living and also the mortgage repayments. Because what tends to happen is that people will effectively make those mortgage repayments and perhaps cut back on other spending, but eventually, if things aren't addressed in some way, they get into more serious financial difficulty later.
Okay. So what are the main demographics that are at risk of having mortgage stress?
Yeah, well, that's another very good question because the sort of traditional narrative, which is the one that the Reserve Bank puts out, is that, there are a small number of households who are actually struggling with mortgage stress and with financial difficulties, but they are the households that, we would perhaps expect. The more affluent households who have the bigger mortgages, they say, are fine. To which I reply, that isn't the full picture, because I see mortgage stress lurking in places that you don't normally expect to see it. So, for example, in and around Sydney, Bondi, for example, is one particular postcode where mortgage stress is very high. And there, it's what I call young affluent households who've bought quite recently, often a renovated or new apartment, big mortgage, have to pay big bucks for the place, but their incomes are not keeping up with cost of living and the mortgage. And I also see, even up on the North Shore, some of the more, what I call the professional households are also now in some financial difficulty. These are often very highly leveraged households. They may have large incomes, but they've got big mortgages and very often investment mortgages as well. So if you look at it holistically, with regard to all of the debts that households have, then you discover that mortgage stress is not confined to the battles, it's not confined to those on the lower end of the income scale. And in fact, banks have been much more rigorous in their lending policies down where incomes are lower. So, for example, the urban fringe around Sydney, they'd be much more willing to lend to more affluent households. So, differentially, there is more stress at the top end of the market than the bottom end of the market.
That is really interesting. I understand the perspective of higher income earners using leverage, borrowing money and investing in the property market, just to name a few, the stock market as well through other means. But yeah, that wouldn't necessarily be the first place that I would have sort of picked, being young professionals in Bondi being ones in mortgage stress. That is really interesting.
Yeah, well, it's surprising. I've been researching this for more than 12 years, and I run my household survey, so I look at data from real households, and then I do some modelling and analytics. So it is based on quite significantly large numbers of households. And I've seen this mortgage stress building and building and building over the last 2 or 3 years. And remember that this is at a time when interest rates are as low as they've probably ever been. So there's something else going on here, and it's to do with high amounts of leverage. And many of those more stressed households will be people with multiple mortgages and multiple properties and 3, 4, 5, 6, 7 investment properties.
And that you've just touched on a really key point that I wanted to bring up, and that has to do with mortgage stress with property investors. And how do you see that playing out?
Yeah, this is probably the most significant change that's happened in the last few months, because for a generation, people have been led to believe that investing in property is a really smart thing to do. You get negative gearing, you get capital gains breaks thanks to the generous government and tax structures, and they've seen these properties go up in value, and you buy one and then you use the equity out of the first one to buy another one, and you buy a third one and a fourth one and a fifth one, and each time you go to the bank and you get an interest-only mortgage, and that keeps the repayments as low as possible, and get as much tax breaks as you can. So that's the narrative, right? And until relatively recently, prices kept going up, and the capital growth was there, and everybody thought it was a wonderful cash-making machine, except that now the reverse is also true. Home prices are sliding, and the costs of investment mortgages have risen. The availability of interest-only loans is much lower than it was. And now, if you put all of that together and then look at the flat rental growth, what you discover is that the investment property boom is well and truly over. And some of those property investors are now being forced to sell one of the properties to be able to maintain the rest of the property portfolio. And when they do the numbers, more than half of them are now underwater from a cash flow perspective. So if you ignore the capital gains that you may have got on paper and look at it just as money in and mortgage payments out, more than half are actually losing money. Now that's a big deal. So my belief is that we are at a very important turning point with regard to property investment, and that's why property investors are voting with their feet and just not taking the mortgages they used to.
The really interesting side of that would be the tax discussion around how that would all be built in. I'm fascinated by that. Okay, I have so many more questions for you, which I think we can bring up at another time. One of the main ones that I have is what kind of a move in interest rates would be considered significant to really put more people under pressure?
So at the moment, we've got about 1 million households, just under 1 million households, who I classify as in mortgage stress. And just to give you some relativities on that, there's about 3.3 million households with unoccupied mortgages at the moment. So that means that it's not quite a third, but getting close to a third. Now, if interest rates went up, let's say it went up 1%, which is still well below the long-term average. The long-term average would be 3 to 4% higher. Let's say 1%. My modelling suggests that we'd see it move from 1 million to about 1.2 million. So that's more than a third. And if rates went up more than that, then effectively there will be an even higher rise in the number in mortgage stress. Now, what happens with people in mortgage stress is they'll keep swimming against the tide for a certain level of time, but eventually that mortgage becomes an absolute noose around their neck, and they have little choice then but are forced to sell or are foreclosed because they can't make those mortgage repayments. And the concern that I have is that as interest rates, if they do rise, we'll see more and more people suddenly get to the point where they have no choice but effectively to think about selling. And if they're selling into a falling market, they may end up with potentially negative equity. Or indeed, if they don't sell but are foreclosed, remember that in Australia we have full recourse. In other words, even if you sell the property and you give all the money, all the proceeds from the property back to the bank to repay the mortgage, you've still got money outstanding on the mortgage. You still have that debt owing, so they can still come after you even if you haven't got the property anymore. So that recourse, the full recourse, means that if prices fall and you're in your negative equity, then you're going to see many more people effectively struggling with that, and potentially the only way out is bankruptcy. So this is a recipe potentially for significant financial pain over the next 2 or 3 years. And as I say, 1.2 million could be caught with the first signs of that, which is mortgage stress, if rates go up.
Yeah, I definitely agree with a lot of what you were saying, and I really like the way that you've framed a lot of that. It really resonates with what a lot of the concerns that I've had seeing financial advice clients as well, and just having that mortgage discussion, having the property discussion, and also what's going on in the marketplace at the moment. For example, over the last 12 months, property prices in Sydney for houses down 7% and it just sort of builds into that whole piece. On $1 million property, that's $70,000.
Just bear in mind that 7% is an average, right?
Yeah,
if you look at, for example, apartments in Ultimo, they're down 22% over the last year.
Mm-hmm.
So, again, averaging masks a lot of the very differential movements that we're seeing. So I'm seeing in some postcodes we are down more than 20%. In others, there's almost no move down. So it depends where you are, the type of property you've got, and a bunch of other things. But unfortunately, if you bought relatively recently, particularly if you bought a high-rise apartment in and around the inner suburban ring, or if you bought a house in the outer suburban areas on a small lot relatively recently, those are two types of properties that I think are going to be under severe pressure ahead.
I can't agree with you more. This is why I like watching and listening to your content on YouTube, because you've hit the nail on the head with how the averages hide some of the real figures. In some areas they're flat, in others they're down much more significantly than the average. So how can people find you on YouTube?
Okay, so there is my website, which is actually called Walk the World DFA.
Mm-hmm.
The reason it's called that is because I have Digital Finance Analytics is my website, DFA, and then Walk with the World is the handle that I use, so you can do that. Or you can go to digitalfinanceanalytics.com, and from there you can see my blog, because I run a blog. You can also access my own podcast, as well as all of the stuff that we do on YouTube. For example, I recently interviewed Steve Keen from Europe, where he now is. He's the guy who forecast property prices would fall, a lot 15 years ago, and it's finally going through. And I've got various other videos there, including a lot of data, because I believe that data is really important, as well as talking to other people in the industry. So people can get a bit of a feel as to the sorts of things that are going on. And I don't have an axe to grind. I've got no reason to sell property or buy property or support the banks or not support the banks. I'm just trying to call it as it is based on the data.
Yeah, and I really do appreciate that. Finally, I'd like to say a huge thank you for coming on to the Music and Money Show, and I look forward to speaking to you in the future.
Very much enjoyed talking with you, and good day to all your listeners.
Thank you.